So you've been wanting to research companies, but you don't necessarily have the time to do it yourself, or you don't know how to do it yourself. In this series of videos, I'm going to be going step by step through my entire process from beginning to end on how I find companies, what I look for when I do my initial research on the companies, if they pass my initial research, how do I value and evaluate them after reading their financial statement. I will go step by step, including valuations when we get to that point, and how to evaluate companies. My name is Jason Rivera, and welcome to Value Investing Journey Case Studies.
Today's case study video, we're going to finish we're going to do our advanced training on how to calculate ROIC. We're going to continue talking about Procter & Gamble and Microsoft, which is who we've been talking about in the last couple of videos. Before I get to that, though, I need to let you know you can get this series as podcast anywhere on the world for free on all major podcasting platforms: iTunes, Stitcher, SoundCloud, Spotify, Anchor, and more. You can get this as part of the I Love Value Investing podcast anywhere on the world for free. Okay, so I'm going to bring back over our sheet here that we worked on last week, where I showed you how to calculate ROIC, the kind of basic way to calculate our ROIC. The basic calculation I use is right here. What we didn't talk about was this section, which we're going to talk about in today's video. Before I get to that, though, I need to let you know how to find the company's annual reports, because you'll be needing the company's annual reports to figure this information out. So let's go over here. So Procter & Gamble's website, typically it'll be here at the top where you want stock information or financial reporting or whatever, or over here on Microsoft, it's not at the top. If it's not at the top of the company's page, it's down here in the investors tab. So what we're going to do here is open up this and find its most recent annual report. It has to be the most recent annual report. The reason being that some of the information, or a lot of the information from the annual report to the quarterly report, is stripped out in the quarterly reports. What you need here is you absolutely have to have the annual report, because the stuff we're going to talk about is not in the quarterly reports. Usually there's a tab for, there we go. Financial statements. Let's see, this might be it. I want the financials, not the income statements. I want the full, you have to have the full financials, not just the income statement or the cash flow statement or any of that. You want the full statement. There we go. You want the 10K. So let's bring, so what we're going to do here is I'm going to make this bigger, first of all, because it's tiny. Then what we're going to do here is we're going to go up here. Again, if it comes up like this, you can search the find button, or you can hit Control F if you're on a PC to find what you need to be looking for. What you need to be looking for here is operating lease. See its work. Okay. So we want this. We want the, if the company has operating leases, it should be, or it should look like something like this. It should look like a table like this. What we want here for Microsoft, and I'm going to bring, I'm going to calculate over here again, and I'll bring this over here, is I'm going to, actually I'll just do it right now, is, so debt and debt equivalent. When I refer to that, it includes things like operating leases and unfunded pensions. We didn't do that before because, again, this takes a little bit more work and a little bit more time, so we want to do that here. But we're going to keep this calculation. Again, I remember from last time, because of my notes here, this is all short-term and long-term debt. These numbers are in billions. So all we have to add here is plus debt. So I'm going to move this around a little bit. So because I messed up last time on that, plus debt equivalents. So I will know from this calculation that these are debt equivalents. And in here, I'll explain all this in a minute. Plus okay. So, and when I do that, just for reference, I call it total obligations because of this. We'll bring this sheet back in a minute. Contractual obligations. So what we want here is typically these, of course, are short-term, long-term debt. For most companies, it will only have operating leases. For this, we will have to go through it to figure out if we want to include this other information. I'll explain how to do that. For now, let's start with the operating leases. You want the most recent year, so this is 2021. You want the most recent year only. The reason you want the most recent year is because things change enormously over time, especially as we've seen with the coronavirus stuff. Things can change very fast. So you want the most recent year only, and then typically you multiply this number by 7. Why 7? We want to find an average value over the long term that we're going to have to pay for these in terms of the operating leases. And the reason we want that is goes back to last video where I talked about thinking as an entire business owner of owning a stock. If you are buying an entire company, which again is how you should think if you're buying a stock, you want to know what the operating leases are. These are typically things like leases on apartment buildings or office buildings, stuff like that. Typically, again, you need to read the note to figure out specifically what it is, which we will do. But typically, these are things you can't get out of unless you pay a huge penalty. So that's why you want to think of this as the entire business owner. And the reason we use 7 is because typically operating leases last from anywhere between 5 and 10 years. Again, you will need to go to the note to figure out exactly the amount of years, but typically they last 5 to 10 years. So we use the middle number of 7. So in the calculation, go to 7 times 2.4. Again, we're in billions. Oops. 7 times 2.4 equals, what's that, 14.7 times 2.4, 6.8. Plus, okay, now we're going to have to go through these notes to see if we should include any of them. Construction commitments. Let's go to that one first. And again, this seems time consuming, but it's ultra important and it'll help you find red flags. Note 7. This is literally what I do every time I research a stock that I get to this stage. Letting Microsoft Word do its magic. It's going very slowly. Okay, well, it's working. Okay, operating equipment. So, what did the note say? Construction commitments, I think is what it said. So, this note is pretty much useless. But what I would say here is I would include these, just this number right here, because of the word commitments. again, you have to think of as you're a business owner. If you were to buy the company today, you would have to pay these again, unless you pay some kind of penalty. So keep that in mind when you come across something like this, which frankly, that note was pretty much useless because it didn't say anything. So, but I'm going to include these because again, they're commitments. Plus 4.8 in construction commitment. Okay, finance leases. Typically, again, these are not included. These are already capitalized up here in the capital leases. But again, I'm going to check just to make sure. While we're waiting for that to work, transition taxes, I will not include taxes in here because, again, those fluctuate wildly. They're not a commitment. And again, we're going to check the note here. Okay, so I don't even have to go to a note here. We'll include these. Again, just this number here because they represent purchase commitments. Again, if the word commitment is there, typically you want to include it. Okay, leases. Okay, operating leases. Okay, yeah, these are already counted. So these are already what's called capitalized leases. These are already counted in the financial numbers. These ones are not, which is why we include these. Most operating leases, again, I don't know why this is. It's accounting rules and regulations. If something is capitalized, which a finance lease is, then it's already in the financial statements or in the short-term, long-term debt consideration. Operating leases are not. I assume this is because most operating leases are over a period of time, and finance leases, again, are kind of more fixed, I guess. I guess you can get out of operating lease better than a finance lease technically. So let's go back up here. So I would not include these. Would not include the transition tax. Already talked about this. Would include this number. Plus 25.1 rounded up in purchase. Okay, so here's what the final calculation looks like. Oop, oh, that's not even the final calculation. I almost forgot unfunded pensions. Pension. Oops. I would guess, being a newer tech company or a new-ish tech company, that Microsoft wouldn't have any pensions. But again, I'm checking to make sure. You do not count retirement, like if they have a 401k plan type of plan, you wouldn't count that in here because those are more kind of funded based on companies. You would include pensions, retirement in here because those are funded by the company over, frankly, until somebody dies. So most newer companies in the United States do not have pensions plans. So this isn't something you have to worry about a lot, but it's something that can make a gigantic difference. When we go to Procter & Gamble, we may see that because they've been around a lot longer. So this is a savings plan. So immediately I know this is kind of like a 401k. And again, it says 401k right there. So we are not going to count these. Let's make sure. Board of Directors retirement, Board of Directors. Okay. So here's the final calculation. Plus 0 in unfunded pensions minus, okay, this was cash, or not cash. Yes, cash equivalents and other short-term investments. So here is our final number. So let's calculate this out. 118.3 plus 71 in short and long-term debt plus 16.8 in capitalized operating leases plus 4.8 in construction commitments plus 25.1 in purchase commitments minus 136.5 gets us a final number of, oops, Oh, I should have copied this, what I should have done. Instead, I'll do this with total. There we go. So again, I will know specifically what it is. 9.5 equals 53.3%. Round it up. So this is still a spectacular ROIC. I look for anything over 10% on a consistent basis. This is otherworldly, and frankly, so is this. You don't ever see companies with ROICs with total obligations with this number. I can't think of one off the top of my head that I've seen actually. So this is spectacular. This means for every dollar, and I explained this more fully in the last video, which again, you can get this below. The last two videos in this series where I explain ROIC, actually, you can get this entire series in the comments below. But essentially what this means is for every dollar in profitability the company earns, or excuse me, for every dollar in operating profit this company produces, it earns 53 cents, or it generates 53% returns based on its assets, which again, you can see what it's basing that on. So this is a combination of debt and equity and cash. Things like operating leases, unfunded pensions. This, again, I look for anything over 10% on a consistent basis, so this is spectacular. Okay. Let's go down to Procter & Gamble now, because this one might have pensions. Bring the screen back. Okay, exit out of Microsoft. My computer allows me to. I'm going to pause this video and bring you back when my computer allows me to do so. Okay, and we're back. So what we're looking for here is annual report. Typically, I download the 10Ks when I'm doing this kind of report because I don't care about the shareholders' information or the pictures or anything like that, which is typically in the actual annual report. 10Ks are typically just the information, straight ahead information. So for this, I will just usually get the 10Ks. We'll read the 10Ks or the actual annual reports with the shareholder letter and everything later if we get to that stage. Again, I'll bring you back. I'm going to pause this while my computer loads. Oh, never mind. Here it comes. Okay, so do the same thing. Control F if you're on a PC. If you're not on a PC, if you're on an Apple, I have no idea what the keys are to do that. Operating lease. Okay, and again, it should look something pretty much always like this. Okay, pensions. They do have pensions. Interesting. So, interest payments relating to long-term debt do not include this. Operating leases, you don't include the total number, less than 1 year. So sometimes the wording is, the charts and the wording are tricky. So, plus 0.26 rounded up times 7 equals 1.82 billion. 82 plus purchase obligations. Go to note 4. Commitments. Again, keyword here. Mental model, whatever you want to call it. Commitments. So as a business owner, I would need to include these. Again, this number right here. Actually, for this, yeah, let's do this. Because again, things can change a lot and change fast. If they wanted to pay a penalty, they could get out of this and that amount would go down. So let's use this. Plus 0.63 and purchase plus, okay. So they do have pensions. You do not include this number. This is their minimum pension funding. You want the unfunded portion of their pensions. Pension, which is often tricky to find. I have an entire training from past students on how to find the correct number because they make it awfully confusing most times. Should be some kind of chart. Okay. Pension benefits, non-current liabilities, not that. Okay, not that. Okay, this is usually the chart you're looking for, something like this. Obligation and funded status, it should look something similar to this. So, unfunded pensions are, okay, so you want this number. Again, every single financial you go through will have different wording. Could say unfunded pensions, could say funded status and show a negative number. Could say retirement benefits, funded and unfunded. This is frankly, I don't know why companies make this so difficult. Well, I do know why they make it so difficult. So people can't find the correct numbers because these numbers are ultra important. And there's also laws and regulations around pensions and valuing them and stuff like that, which makes it harder for the companies, I admit. But there should still be kind of a uniform way. But this is the number here. Funded status, negative $5.6 billion. So think about this. We're looking for the unfunded pensions. So if it's a negative, that means it's not funded. That's why we're using this number. So plus 5.6 in unfunded pensions. Frankly, again, the important part here is it should be a chart similar to this, and the wording will always be different. Frankly, I can't go through all the examples of how they're different right now, because again, it's different literally by every single annual report. So if you have questions, let me know. If you're coming across a stock and you don't know if it's unfunded pensions or not, let me know, and I'll try to help. So negative 5.7, rounded up, and unfunded pensions. Okay, so that should be it for that. So here's the full calculation for without total. Again, if I was doing this for long-term purposes, I would go back and fix this because I would want to know the calculation for each, but to save time, I'm just going to fix it here since I messed up on both of them. Okay, so let's calculate this out. 45.9 plus 12.7 plus 23.3 plus 1.82 plus 0.63 plus 5.7 minus 15.4. So 74.6 divided by 74.65. One other note is these are in millions right here. The reason I wrote, again, I said this in the last video, so I know every single time I'm looking at a financial statement what the numbers are, so I don't have to guess. But if you're doing that, you need to put millions in the decimal places. You need to leave billions like this. or you're going to get super confused and off track, and the numbers could be wildly off. Trust me, I've done it many times before, where I've had to do the calculations over again. 74.65. So 20.6%. That means I would peg Procter & Gamble's current kind of real world ROIC at 20.6%. Why would I say that's more real world? Because it includes the total obligations. It includes things you would want to know about as a total business owner, like unfunded pensions and operating leases, and purchase obligations. That's why you need to calculate this number by yourself, not only so you can get kind of a more real world number, but so you know what goes into the calculation. Like I explained in the last video as well, is I don't know what goes into Morningstar's calculation, but I can tell you exactly with 100% accuracy what goes into this calculation. So I know what goes into it. I know why it's important, what it shows, what's in it, what these things show, because it's not just this number. Again, this number is ultra important. But does the company have an enormous amount of debt and long-term obligations that don't show up in a regular ROIC calculation that we did last week? This is why I take the extra time to do this calculation. Again, it took me 26 minutes with pauses, with slowing down to explain everything, with all that. So it doesn't take up a huge amount of time, 10, 15 minutes. And this was 2 companies. So let's say 10 minutes a stock. Again, less on that with as you get better at this. But it gives you an enormous advantage over others because you see the true kind of outlook of a company based on its, as a business owner would look like. Total obligations, operating leases, cash, debt, all that kind of stuff. So I hope you learned a ton in this kind of mini series. If you have any questions, comments, concerns, let me know in the comments below. If you're watching on YouTube or the blog, the links for the past videos in this series and the resource to get this valuation, value investing journey valuation and profitability metric template, where you can get all of these calculations, ROIC, ROC, TEV, EV, all these things, and valuations. You can get that for free by signing up and inputting your email address, first name and email address below. Again, you get that for free. It's like a 25-page doc me and my team put together to help students. If you're listening on YouTube, like, love, share, subscribe, comment, hit the notification bell so you're notified every time we release a new video. And we're releasing new videos all the time. If you're listening on the podcast, like, love, share, subscribe, comment, all those good things as well. And we would really appreciate a review, because the more views, reviews, and listens we get on our various platforms, the more people we can help with this kind of content. So until next time, have a great day. Talk soon.